Good morning. My name is Gavin Smith. Today I'm going to be taking you through Barclays Africa. So starting off with the nature of the business. Retail and Business Banking South Africa, or RBB for short, is the largest division, making up just over half of the group's headline earnings. This division consists of home loans, vehicle finance, cards, transactional services, and others. The cards business also includes the co-branded products and partnerships, such as the Edcon Book and Woolworths Financial Services. Corporate and Investment Banking South Africa, or CIB, is the second largest business, accounting for 22% of earnings. By business activity, including CIB Rest of Africa, the corporate business makes up about 37% of headline earnings. This is a relatively smaller contribution when compared to Nedbank and Standard Bank. WIMI, or Wealth, Investment Management and Insurance, is quite small in the overall group. There are operations both locally and in the rest of Africa, although the majority is based here. The life and short-term insurance businesses increases earnings volatility from this division. Geographically, the rest of Africa makes up around 20% of earnings, the biggest component being CIB, which makes up 15%. This was quite a strong growth area in the first 6 months. Moving on to our recommendation. The group is facing a weak revenue growth environment with muted loan growth and non-interest revenues. This is not specific to Barclays. We've seen it with both Nedbank and Standard Bank. In the absence of the sharp decline in credit provisions, which I'm going to discuss in the next slide, earnings would have been lower, which reflects on this tough environment. Although the results for the first 6 months showed slowing trends, this was not necessarily outside of management's guidance for the full year. We are, however, concerned with the weak performance and competitiveness of the South African retail business, as it is the largest business in the group. This division has lost clients. On the positive side, the retail business has still shown modest growth in deposits and more targeted investment into client acquisitions. Against this backdrop, cost management efforts and growth in the African business are essential to maintain growth. The recent interest rate cut, together with any additional interest rate cuts that may occur in the future, will put pressure on lending margins going forward. On the other hand, lower rates provide relief to already overburdened consumers, which is positive for affordability. In our valuation, we do not account for the 12 billion rand received from Barclays plc for the separation, as this capital will be consumed over the next few years. However, these funds provide an opportunity to improve efficiency as older shared systems with Barclays plc are redesigned. Although the additional capital helps alleviate some of the operational risks with the separation, there is still uncertainty about the loss of future business. As an example, if Barclays plc has a UK or European-based multinational client, and that client is looking to expand into Africa, then Barclays Africa would facilitate this expansion. After the separation, this is less certain. However, it is still important to note that Barclays plc does still have a minority stake in Barclays Africa. In conclusion, we believe that there is sufficient margin of safety in the valuation to compensate for the weak outlook. We therefore recommend an overweight position in the share with a recommended exposure up to 5.87%. The share is trading at 1.3 times its net asset value, and it's also underpinned by an attractive historic dividend yield of 7.1%. This next slide shows the discount that Barclays is trading relative to its competitors, being the JSE Banked Index, and this is based on a price to net asset value basis. The gold line represents a 5-year average, which is around a 20% discount. It is important to note here that FirstRand and Capitec are in the peer group. Both of these companies have higher ROEs to the other banks, therefore they justify higher price to net asset value multiples. This is one of the reasons why Barclays, on average, trades at a discount to the peer group. The grey lines, above and below, are 1.5 standard deviations away from the average. Currently, Barclays is trading at around a 31% discount to its peer group, which is well below the historic average of 20%. Although the outlook may not be as strong as some of its competitors, its profitability, measured by the return on equity, is broadly in line, with the exception of FirstRand and Capitec that I mentioned earlier. This supports our view that the valuation provides sufficient margin of safety. Moving on to the financial review, just as a note, I'm presenting the results on a normalized basis, which excludes the effects of the separation. Net interest income or NII increased by 1%. In constant currency terms, NII was up 3%, reflecting the effect of the stronger rand on the group's African businesses. NII was driven by a 2% increase in loans and advances, or 3% in constant currency terms. This offset a lower net interest margin. The margin was negatively impacted by faster growth in corporate loans compared to retail, as corporate loans generally have lower interest rates, an adverse change in the funding mix with a greater reliance on wholesale funding, and the implementation of NCA interest rate caps, which affected the unsecured lending books. Credit provisions dropped significantly by 27%. Although impairments were lower across the board, most of this decline was due to CIB. CIB had two large specific write-offs in the comparable period, as well as an increase in central provisions. The credit loss ratio, which expresses provisions as a percentage of loans, dropped to 0.96% from 1.29%. Corporate loans generally exhibit less credit risk than retail. So if you had to compare a portfolio of corporate loans to a portfolio of retail loans, the corporate portfolio would have a lower credit loss ratio. However, because these portfolios are more concentrated, a single default in the absence thereof has a larger, more erratic year-on-year impact on earnings, as seen in these results. Non-interest revenue declined by 1%, but was up 1% in constant currency. Fees and commissions, a more stable component of NIR, was up by 3%. The cost-to-income ratio increased to 55.6% from 53.4% on the back of slow revenue growth, as operating expenses were well managed, only increasing by 3%. Diluted HEPS was up 7% or 11% in constant currency terms. This was mostly due to the decline in credit costs, which is not recurring in nature, as I mentioned earlier. On a pre-provisioning basis, profits were down 3%. Net asset value per share increased by 4% to 112 Rand and 62 cents, and the return on equity improved to 16.8% from 16.1% in the previous period. The interim dividend was up 3% to 475 cents, which is behind the 7% growth in headline earnings per share, although this was guided by management. Now onto the divisions, and starting off with Retail and Business Banking, South Africa. NII was down by 2%. This was due to margin pressures, in part due to the NCA interest rate caps, as well as a slow revenue growth of 1%, which reflects a 7% increase in business banking, 14% increase in the transactional business, and 6% increase in vehicle and asset finance. This offset declines in the card and home loan portfolios. Deposits were up 5%. Strong collections and previously implemented risk management initiatives supported a 9% decline in credit impairments. NIR was up 4%. The growth was driven by price increases, an increase in merchant acquiring volumes, and growth in cards, both debit and credit. Investment in client acquisitions and IT resulted in expense growth that was ahead of revenue. Consequently, the cost-to-income ratio deteriorated to 54.2%, up from 51%. Ultimately, headline earnings were down 9%. Moving on to CIB South Africa, NII increased by 8%, reflecting a 6% increase in loans and better margins. As I mentioned earlier, credit provisions dropped substantially with a lower credit loss ratio of 0.18%, down from almost 1% in the previous 6 months. NIR remained level due to weaker trading activity that was offset by strong investment banking fees. Expenses were well managed, which is seen in the improved cost-to-income ratio. Lower credit costs were the main driver of the 76% increase in headline earnings. However, on a pre-provisioning basis, the business still showed decent growth of 6%. Now moving on to CIB Rest of Africa. For the African divisions, I'm going to discuss the performance on a currency neutral basis, so to reflect the underlying performance of the businesses. NII was up strongly by 32%, driven by higher margins and an 18% increase in loans and advances. Provisions dropped significantly with a lower credit loss ratio of 0.6%, down from 1.34%. NIR was down 9%. However, this was due to the reclassification of lending fees to interest income. Excluding this, NIR showed an 11% increase. The cost-to-income ratio improved as expenses were only up 7% against strong revenue growth. Headline earnings were ultimately 61% higher. Next is Retail and Business Banking, Rest of Africa. NII fell by 1% due to challenging conditions in several markets. This included interest rate caps in Kenya and liquidity constraints in Zambia. The credit loss ratio improved to 2.49% from 2.72%. NIR fell in line with net interest income by 1%. This was driven down by lower transactional activity and the ongoing migration to cheaper digital channels. Although expenses only grew 2%, the cost-to-income ratio deteriorated. Headline earnings were up 5% on the back of lower credit provisions and a decline in profits attributable to non-controlling interests. Lastly is WIMI. From the continuing lines of businesses, which excludes the crop insurance business, reported a 6% decline in headline earnings. This was impacted by catastrophic events in the Cape, being the Knysna fires and Cape Town storms, which affected the short-term business. In life, embedded value increased by 9% to 5.1 billion, with a strong return on embedded value of 32.1%. Wealth and investments earnings were flat, although assets under management were up 4% to 211 billion, aided by net inflows of 6 billion. Lastly is the company guidance. Locally, GDP growth is expected to remain muted for the remainder of the year, while the outlook for the rest of Africa has improved marginally. The group is expecting another interest rate cut in September, given that inflation is already well within the Reserve Bank's target range. Increasing price competition in the retail space and strong COPs also bode well for the future inflation outlook. Management have continued to highlight political instability as a risk. This is also something that the rating agencies watch closely. The guidance for the full year has remained unchanged, with low to mid-single-digit loan growth, a slight contraction in the net interest margin, slow revenue growth leading to a higher cost-to-income ratio, an improvement in the credit loss ratio, a relatively stable return on equity, and faster growth in the rest of Africa when compared to the local businesses. The group has also guided that they will continue to increase dividend cover over the medium term. That concludes my presentation. Thank you for listening and enjoy the rest of your day.